Investing is all about risk management. In syndications, through the economies of scale and lower volatility risk, you can mitigate your overall investment risk.
Think about it like this. If I buy a single apartment to rent out, I've got a bunch of fixed costs like marketing for tenants, maintenance, and property management. But what if I buy an entire apartment building? I'm still dealing with the similar types of expenses, but now those costs are spread out over many units instead of just one. The more units I manage, the cheaper each unit becomes to maintain and operate. This scaling effect means lower costs and higher profit margins per apartment. And that's the magic of economies of scale. By leveraging this in real estate, I can increase my return significantly while managing resources more efficiently. It's all about making smarter investments to get more bang for your buck.
Real estate syndication offers lower volatility compared to private real estate funds. Essentially, if you invest in a private fund and the market dips, you might lose money if you need to sell when prices are down. With syndication, it's a different thing. It's a long-term investment, meaning there's no pressure to sell during a market slump, and you can hold on to your investment and wait for the market to recover, which overall reduces your risk of loss. Not only does it provide more steady income, but also makes your investment more resilient against market fluctuations. By investing in syndication, you're in it for the long haul, which can make your financial journey smoother and more predictable.
Additionally, the costs are super manageable. Often, management fees are low or even non-existent because the profits are designed to benefit the group, not just the managers. This means more money that stays in your pocket.
The best part, right now, is it's one of the best times to invest. One of the reasons is because of the COVID bridge loans. As people purchased properties in the booming market during COVID, they didn't anticipate increase in rates, and thus many investors forewent the bridge loan that could affect the amount of debt incurred on the interest change.
Not only that, but with COVID and the Great Resignation, it has brought about so many different economic changes, such as decrease in large corporations and an increase in travel and following one's dreams of living a free life. This has made single-family houses and properties more obsolete than ever.
With that, many young people are opting for cheaper housing solutions, thus bringing an increase to the need for multifamily housing. Right now is an amazing time to get in while early and reap the benefits of doing so.
So that leads us to the next question. Why us? The way we do our investments is nothing new, to be honest. But our efficiency and our effectiveness in these processes is truly what differentiates us.
As a financial analyst who happens to be a partner with a company like BlackRock, I utilize skills I built to analyze and underwrite each property, ensuring a smart investment. The way I do it, the net operating income, aka NOI, which tells you about the property's profitability after covering all operating expenses, stuff like utilities, insurance, taxes, and maintenance. Simply put, it's your total income minus operating expenses, giving you a clear picture of the operational efficiency. Next is the cap rate, which is calculated by dividing the NOI by the property's market value. It's a key indicator that shows you the potential return on your investment, helping you compare different properties quickly. And finally, we assess the property's condition. This is stuff like who is the builder, and are they good and reliable? What is broken or missing? What can be improved? And is everything functional? This is all great, but it's completely useless unless we have an idea of the market we want to purchase the property in. We do this by assessing economic indicators such as job growth, job diversity, industry coming to the area, population growth, and several other factors. We double and triple check all of these things to ensure transparency to all of our investors as well.
The next part of how we do our investments is by helping you, obviously, increase your investment. Here's how we have turned our investors' initial investment of $50,000 into $1.5 million. So through effective management and market appreciation, that initial investment doubles with each property cycle. The way we do that is by targeting what's called an equity multiplier. So through our underwriting process, we solely target properties that will double your investment. Now, once we exit the property, your original investment is now doubled, which then you roll over into another deal. Now, after 5 full cycles of doing this, your initial investment of $50,000 could multiply to over $1.5 million.
We don't do all of this just for ourselves. We become truly happy when we see people secure more freedom and money through our help. The most meaningful thing that Lucas and I do is impact your life in a positive way. With my ability to analyze and assess and Lucas's ability to connect and nurture, we truly have a great team that's set up for success.
And everyone asks, so how do you increase the cash flow, just like any business? You decrease expenses and increase value. Sounds obvious, but here is how we actually do it. So first, we do strategic renovations, such as adding new floors, paint, cabinets, countertops, and really just renovating the unit to a modern market standard. And then we raise the rents to market and continue adding value by updating amenities and increasing operational efficiency. We use numbers and industry standards to ensure each part is performing how it should.
Another thing we do that is unique to TR Capital Partners is we'll actually pool our resources with other investors to enhance our buying power and share the benefits of the passive income. And of course, we do all this to secure a legacy and financial freedom through passive income. Here's how the passive income works.
Now, this is really deal dependent, but we will target an IRR, or an internal rate of return, of at least 16 to 20%, and that investors will receive a preferred rate of 8 to 10%, ensuring that they will get paid that 8 to 10% before we see a dime, to ensure we have alignment of interest and make sure we are incentivized to make the property perform.
Going along with that, you can't forget about the tax benefits, cost segregation, pass-through income. These aren't just fancy terms that make us feel smart. They're strategies that reduce your taxable income, making your investments even more profitable. The first key tax strategy is using cost segregation studies. This technique allows you to accelerate depreciation on certain parts of the property, such as fixtures, furniture, and even landscaping. Essentially, while your property may appreciate in market value over time, on paper, it depreciates faster due to these studies, providing substantial tax write-offs each year. The other strategy is pass-through income tax strategies. All these losses from the property, like those major repairs or renovations, can be passed through down to your personal income. This lowers your overall taxable income significantly. For example, if your real estate investment generates a loss due to a large upfront repair cost or aggressive depreciation, these losses offset your other taxable income, such as wages from your job. In essence, it's not just about earning more money. It's about strategically keeping more of what you earn. By leveraging these tax benefits effectively, syndications not only become more profitable, but also more sustainable in the long run.
You already see the significant benefits, and we haven't even discussed the true assets value, AKA equity. Now, equity ownership is based on the total amount of the equity raised. So depending on how much you invest in relation to the raise, that determines your ownership percentage. Now, an example is if we're raising $1 million and you invest $100,000. You now have a 10% ownership stake.
You'll get the passive income from the rent profits based on your ownership stake each quarter. Add in the tax benefits throughout to lower your tax burden and the equity upside. Syndication is made for an investor that truly wants generational wealth.
So all in all, we are not saying that our methods are better or the only right way to build your financial freedom. Just from our experience, this is the best way we have found to create income that is truly passive and ensures that you have more time for your passions and family.
Through these strategies, we've not only multiplied our investment, but also gained invaluable experience. We've learned from each project, each challenge, which has made us better investors.
Comment invest, and we will send you a link to set up a call with a team member today.